name is Cristóbal Doberti, and I am part of the Media and Editorial Committee of the CFA Society Chile. This webinar is part of several activities that currently the Society has organized for its members and candidates. First of all, we would like to thank to our sponsors, Sartor Finance, Moneda Asset Management, FINSA, and Scotiabank, who support our society and related activities. Today, we're going to have the opportunity to have the conversation with Mr. Chen Zhao. Probably, Mr. Chen Zhao does not need any kind of presentation for those practitioners involved in the financial markets. Mr. Chen has developed an extensive career of over 20 years researching financial markets and advising several financial institutions and practitioners within the industry. Currently, Mr. Chen Zhao is founding partner and chief global strategist for Alpine Macro. Mr. Chen Zhao is already with us, and I would like to thank him for joining us and sharing your insight of our candidates and members of the CFA Society Chile. Also, we have people from other societies around Latin America, so we welcome all of them. Mr. Chen, thank you very much for being with us today.
My pleasure.
Mr. Chen, this has been like kind of characteristic years after a recovery from the pandemic that we suffered last year. So in order to start the conversation, I would like to ask you to know if we can review a little bit your economic perspective that we might have over this year. The vaccination process has gone through the developed countries, emerging market has been behind in that process. How this is going to impact the recovery over this year? What do you expect for the second semester of the year? Who's going to lead the recovery? And what are the main risks that the regions might face in this recovery process derivated from the vaccination and the fiscal impulse that we have seen in the markets over the last months?
Hi, Crystal. I think you were raised a lot of questions. So let me try to answer one by one. The first one, I think you're asking, just review for the past year. How have we gone this far? If you recall, exactly a year ago, the world looked very differently. I remember that at the time when the economic shutdown just started, we just started from working from home, and I was on the CNBC every day. You know, the world looked like it's a really bad place. I remember a lot of interviewees from CNBC anticipating the world's are going to come to an end, basically saying that, you know, this is so bad that we will never see the stock market being at the last year's level anymore. Actually the reality has played out to a large degree, you know, completely surprised everybody. I think there are a couple of things we've learned. First of all, we always believe that the pandemic, anybody who read our research, we always hold this view that the pandemic is a transitory shock. It's very different from the global financial crisis. Global financial crisis, you damage the banking system. Nobody want to borrow, nobody want to spend anymore. Whereas the pandemic is always a transitory crisis that it's always you have some kind of economic rebound afterwards. That's the first point that we want to emphasize, and it played out more or less like that. The second thing here is that the policy response is unprecedented. I think if you think about long-term implication of this pandemic going forward, it's really the dramatic change in fiscal policy. Monetary policy, we did it before. During the global financial crisis, the Fed did exactly what they've been doing, which is quantitatively ease, bring down rates to zero, and then, you know, you open the credit line. But what happened? What made this whole thing different is fiscal response. We're talking about today. The federal government of the United States had thrown in about $6 trillion of income subsidies to the economy. It never happened like that. It's truly unprecedented. And then if you look at the impact of that, actually, it had made a huge difference in terms of restoring the confidence. I don't think it has made a huge difference in terms of the economic collapse, but it has made a huge difference in terms of stock market recovery, in terms of bring back the confidence of consumers. So that's the second thing that I think we should think about in terms of long-term changes in the whole world. The third thing, of course, is the likelihood and the strong possibility of some kind of economic boom going forward, because we had such a huge pent-up demand that are being accumulated. Everybody's ready for a party. I'm telling you, in my colleagues at Alpine Macro, we're all ready for a party. As long as everybody get vaccinated, you can see a burst of economic activity all around the world. I think that is for sure going to happen. The stock market is already anticipating that. That's why I think if you look at around the world, basically the commodity market is looking for some kind of recovery boom. The stock market is looking for some kind of economic recovery boom. Now the bond market is also recognizing the fact that the world economy is going to go a whole lot stronger going forward. That's why the yields are backing up. So this is all same story. We're talking about a recovery that most likely develop into a recovery boom. That is very important as far as the investors are concerned. So I will, make this a few points. This is basically a dramatic turnaround brought about by policy shift, very decisive one around the world. It is also a shift that has proven that the crisis of this nature, natural disaster, is always create transitory shock. It's not the same thing as a financial crisis. That's why I think these are the 2 or 3 points I want to highlight. Back to you, Crystal.
Yes, thank you, Chen. You mentioned something really interesting and something that actually is connected with something that happened today.
Yeah.
You mentioned like the stimulus coming from the central banks, right?
Yeah.
Today, the Fed increased his economic forecast, right? But at the same time, they said that they were not going to probably increase his rates after 2023.
Yeah.
What happened? What do you see there? I mean, is that the Fed probably is going to react a little bit late? I mean, is the market pricing how it was doing it before? I mean, pricing and increasing the rates before. Do you think that the Fed is like running behind the curve? What is your opinion about that?
Absolutely. I think you put your finger on something that is hugely important. I want everybody here in this conference keep this thing in mind. This is a hugely important issue. Why? Think about the last decade after the financial crisis, from 2010 all the way to 2020, last decade. What was the dominant feature of Federal Reserve's monetary policy? The dominant feature of Fed policy was this: the Fed policymakers were consistently more optimistic about the US economy. That's why their rate projection, their projection of interest rates were always higher than market expectation. Proof? Yeah. If you look at the dot plot last decade, the dot plot by the Fed FOMC members were always higher than market expectation. The expected market rate was a whole lot lower than the Fed. That's why we kept telling people, we kept telling investors, the Fed was much more hawkish than the market. What happened? Well, last decade, what happened was very often you're going to see a periodic stock market shakeouts. 2014, 2015, very bad market. 2018, very bad market. Remember, the whole thing basically culminated into a collapse in stock prices by the end of 2018 because Powell, fumbled and misspoken on the policy. So that was the combination, that was the result, the consequences of the Fed being way too more hawkish than the markets. You got a periodic stock market shakeout declining. You look at this chart here, you can see the inflation expectation fell, tracked down. And then you had a falling commodity prices and you had a strong dollar. That was the consequences of policy mistake, meaning the Fed was more hawkish than market anticipation. That was last decade. This decade, so far, they have turned it around completely, upside down, 180 degree. So the market right now is saying, well, the U.S. economy is going to do great. The policymakers saying, no. We're not going to do anything. Today, they are still, look at today's dot plot today. The first rate hike was going to be at the beginning of 2024. Whereas if you look at euro-dollar curve, the euro-dollar curve already priced in 4 rate hikes next year. You know what? If you look at this chart here, on your right-hand side, this is a months, the market anticipation of months before the first rate hike. Rising stock prices, rising bond yields have already brought forward the expected rate hike, first rate hike, by cutting the time by half, more than half. You know what? You hear that from me. I think next year, second half of next year, we're going to talk about tightening monetary policy. The curve will continue to be brought forward. Okay. I think by the end of this year, we will talk about tapering.
Okay.
By the second half of next year, we're going to talk about lift off. Okay.
And from that scenario, how far the yields can go up? I mean, what should we expect from this year? And probably something really important for the stock market that it's been a little bit nervous over the last weeks. When can the yields start damaging the stock or the risky assets? I mean, how far can go the yields in order to start affecting the valuations of the stock market?
Don't be worried. Why? If you think the Fed was more hawkish than market last decade, you end up with a poor stock market, falling commodities, falling inflation expectations, a strong dollar. Well, think about the other way around today. If the Fed is always lagging behind, the Fed is more dovish than the markets, you're going to have a booming stock market, rising bond yields, rising commodities, and most likely periodic dollar weakness. And so in other words, the reason I mentioned last decade is that think about this decade, you have the opposite situation until the Fed is caught up with the expectation. Remember, last decade, the Fed was caught up eventually with the market expectation because the market expectations always prevailed. The market action forced the Fed to pull back from the hawkish stance and conform with the market. This time around, it's going to be the same story. Booming stock market, rising yields, rising commodity, eventually, most likely, a higher inflation is going to force the Fed to move earlier. Until then, the stock market is going to be fine. It's the same story of last decade, but in the opposite direction.
Okay, and what about the valuations of certain sectors, for example? Because the markets has also been concerned about the valuations that some sectors have already reached, right?
Yeah.
So do you see some similarities?
Yeah, let me answer your first question first.
Okay.
How high the yields are going to go? I think it's going to be more than 2%. Look at my chart here. On the right-hand side, that's my bond model. The fair value is at 1.6. Right now, we're right at this fair value. But if you look at history, the bond market sell-off never ends in fair value. It's always overshoot in yields or undershoot in prices, which is on your right-hand side chart. You can see both are not finished yet. Okay. That's what I'm saying. Be prepared. Yields are going to creep higher, most likely be 2 and 2.5% even. What's the problem? I don't think that is a issue, to be honest. I think the yields are going to go higher because the economy is going to boom. Okay. Now, valuation. That's going to be a problem. That's a very interesting question. I'm not saying that is going to be a problem. So I think the market is already in the early stage of building an equity bubble, very similar to the 1990s technology bubble. Why I'm saying that? Look at this. Look at this chart here. If you remember, I mean, some of you probably do, in the 1990s, the whole technology bubble was driven by 4 horsemen. What is the 4 horsemen? It's a Cisco, Intel, Dell, and Microsoft. 4 stocks basically drove the NASDAQ. Today it's a FANG. Okay? Market is very bifurcated. Same story back in the 90s versus today. Look at the NASDAQ. This is NASDAQ right now. This is the NASDAQ back then. Meaning we're still tracking the mania, the bubble. We're still tracking the bubble. We're not getting there yet, but we're on our way. That's the first point. Second point, lots of similarities here. If you look at the chart, it's getting scary here. If you look at the chart on your right-hand side, this is the number of IPOs without positive earnings. Back in the 2000, 80% of new IPOs got no earnings. Today, 80%. Very similar, okay? So these are the similarities. So am I telling you that we are very close to the top? No, I'm not saying that. I think there's a lot of similarity that basically lead me to believe that we're in the building bubble stage. But there are a lot of differences too. What are the differences? Look at this. You ask the valuation, Crystal. If you look at P/E ratio today versus 2000, we're comparable, very close. But that's very superficial. What I'm saying is superficial. This is a very high reading, but it was taking place at a peak earning. What I'm talking about peak earning, you remember the US economy got a recession in 2001. So this very, very high number took place when the earnings was at the top. Here, if you look at this side, we still have very high multiples, but this high multiple is taking place at a trough earning. We just had a recession. That makes a huge difference. If you have a peak earnings, then your earnings can only go down. But if you have a trough earnings, your earnings are swinging backwards, upwards, and that actually deflate your multiples, your P/E ratio. You can see this is a forward P/E ratio. It's already coming off. The reason that the P/E ratio is coming off is not because stock market is having a problem. It's because earnings are strong. So that's the key difference you got to keep in mind. That's why this bubble, if it is one, it's going to last a lot longer than before. The second thing is, when the stock market topped out in 2000, the US Treasury yield was 6.5%. Today, it's 1.6. Okay? So this is equity risk premium, which basically is earnings yield of common stock S&P 500 minus Treasury bond yield. Look at here. In 2000, equity risk premium was negative. That was a total nonsense. We know that in hindsight. Basically, the market is saying stocks are safer than bonds. That is total bull, full of it, because it was a mania. Everybody getting crazy. But all I'm trying to say here is, if you look at today's equity risk premium, we're talking about 300 basis points. It's not completely wildly out of whack with reality. By the way, this number is already incorporated the recent rise in yield, meaning the recent rise in yield actually is already in there. So that's all I'm saying here is there's key differences, and the most important differences is they have a very dovish Fed. The Fed is lagging behind. And then if you have a lagging Fed, if the Fed is more dovish than necessary, you basically are guaranteed for stock prices to rip.
Okay, and some investors has been calling for a rotation in the trade or the bets that they do in the portfolios, right? Because the growth, I mean, trend was the dominant one that we saw over the last years.
Yeah.
And in this current environment, we might see a rotation to value, right?
Yeah.
What is your view and opinion about this trade?
Well, this is already happening. So I know that it's getting very popular. But any clients of ours, if you read our research a long time ago, like 6, 7, 8 months ago, we're talking about rotation. At the time, the rotation barely started. Right now, I think it's becoming developed. But all I'm saying here is, if you look at this chart here on your right-hand side, I don't think this is over yet, this rotation story. I think will continue to play out. The reason for that is that I said, the yields are backing up to 2, maybe 2.5%. We're not done yet. So when the bond yields start to go up, what happens? Long duration stocks will have a problem. Will basically have a problem to expand your multiples. Once the Fed is lagging behind inflation curve, I don't think we're going to have a rising inflation, a huge jump in inflation, but I think inflation is going to creep higher. You have a boom in the world economy. Commodity prices are going to go up. The inflation rate is going to stay moving towards 2%. Cyclicals, industrials, the banks, they're all going to do great. That's why I'm saying this game is not over yet, even though lots of people are doing the same thing, the rotation, but it's historical regularity. Every time you have a steepening curve, banks always do better than others. Cyclical always do better than the high duration stocks. Energies always do better than the technology. So I think, to answer your question very simply, don't leave that trade yet. This is not done yet. We're probably once you are approaching 2%, 2.5% long end of the curve, that's when you start to think about unwinding these positions.
Okay, and going to the regional perspective, because we just mentioned a sectorial one, right?
Yeah.
Which are the regions that might lead the returns? I mean, focusing on the stock
Chile.
market.
Yeah.
Which are but focusing on the stock market, without the region globally, like emerging, developing, within emerging, Asia or Latin America has a better perspective. Which one of the regions that should lead the performance that you are forecasting for this year?
Yeah. China is the first major economy got into pandemic crisis. Is the first economy that get it under control. And naturally, it will be the first economy that are going to normalize the policy. It's already beginning. You can see that actually the SHIBOR rate, which is the interbank rate, has already jacked up by 50 basis points. You can already see this, the government officials and central bank policymakers are beginning to warn that you don't want to be speculative on the property market. They already curtail lendings to asset markets. It's already happening. They are beginning to renormalize the policy. So that's why this is not a spot you want to be very heavy in China. Okay, we actually downgraded the Chinese allocation about 2 months ago. If you follow our research, I think this will continue to be a right call. That's one point. You want to be avoiding the countries that normalize their policy first. And that happened to be China. And the next one could be the United States, second half next year. That's when you start to be careful on policy, careful on yield curve, careful on the dollar, right? Not yet. So where to go? I think cyclical is the place to go. Where are the cyclicals? The cyclicals are in European equity markets. If you look at the European equities, the stock index, the Pan-European stock 60, they are heavy in banks. That's why they are doing great. If you look at German DAX, they're heavy in industrials. They're doing great. They've been outperforming the US and still does. And if you look at Swedish market, it's going through the roof. It's soaring. And as long as the recovery story remains intact, I think this high beta market is going to do very well, including Japan. Okay. I think the game is not over yet. I think you should be more into the international market until really the dollar is ready to strengthen. I think right now is not the point. In terms of emerging market, as I said, I don't like China. I don't like Korea. I don't like Taiwan at this point. The reason for that is these are Taiwan and Korea are high duration market, because how many stocks in Taiwan? One stock actually dominate the market is the chip maker. It's like a very high multiple. Korea is a Samsung. It's like a high multiple. It's not that these companies are doing great, but because of the yields are drifting higher, than their multiple coming off. So I think going forward, this chart, you guys, Latin clients must like. This is a long-term chart. The blue line here is the relative performance of commodities to S&P 500. This is like 20-year bear market in commodities relative to S&P 500. I think that bear market is over.
Okay.
That's why I think that's why we tell our clients, you got to get commodities. You got to get some commodities in your portfolio. I don't care whether it's a GSG or SU or whatever. So
Okay.
bottom line, be long commodity plays and be short high duration market and be short the countries where the policy normalization takes place first.
Thank you, Chen. You have mentioned like many different kind of topics, like in this answer that are quite interesting. The first of them is the dollar. I mean, you said that you see that a change in the trend to the dollar. I mean, what is the fundamentals that can drive a new trend in the dollar? Which are the triggers that we should be looking for in order to see that trend after?
So the dollar story is this. Right now, again, just use last decade as a roadmap, okay? The Fed was more hawkish than market. As a result, you had a periodic dollar strength. It's not a whole decade dollar just kept going up. No, the dollar basically steady, and then 2015, 14, 15 got a pop. And then 2018 got another pop. So you got a periodic dollar strength as a result of a Fed being more hawkish than the market expectations until the Fed got caught up, the dollar came down. Now, think about that as a roadmap. Today's environment, the Fed is behind the curve. Fed is more pessimistic, more dovish than the market. Naturally, the stock price is going to rip, going up. Naturally, the dollar is not going to rally that much because the Fed is dovish until the Fed start to catch up, or the Fed policies start to get caught up. When that happens, I think second half of next year, maybe next year, early next year. Be careful on the dollar, weakening dollar story. I think dollar start to have a problem in terms of continue to fall. The dollar probably start to strengthen. Bottom line here is, make no mistake, the Fed is going to be the first central bank to normalize policy. It's going to be before the Fed, before the ECB. It's going to be before Bank of Japan. Now they are purposefully leave the rate unchanged. They are purposely be more dovish than market expectations, but they can do so only to a point. At some point, they have to catch up. And I think that point will be the second half of this first half of next year when they start to taper, and the second half of next year when they start to lift off rates.
And Chen, you also mentioned something really interesting regarding the commodity market. I mean,
Yeah,
some prices has gone really like
strong.
up strong considering what they were like last year. I mean, not only the oil, right, that
You
it has
guys must be
recovered.
happy. Copper is $4. Come on, Chile.
Exactly, and also
Yeah,
copper and all industrial like materials, right? And
yeah.
some people is saying that we might be facing another super cycle in the commodities, right? What
Well,
is your
yeah.
opinion? It's
That's what
something that is sustained. Sorry.
I just said that here.
Mhm.
This chart. This is a long-term chart. If you have a super cycle, you want to be here, right? This is S&P relative to commodities. When the blue curve going down, it means commodity prices going up relative to S&P, right?
Yes, but then one question, because at that
Yeah,
period we had like a variable that was supporting the price, which was the investment in
right,
China, right? But this time,
right.
since that we are not going to have that boost, how the
Yeah,
prices are going to be sustained after the lag that we have seen in the supply recovers is
we
something that
don't
is going
know.
to be a one-time. Okay.
Well, let me qualify this. I don't want to get you guys all excited about it. Uh, from methodology point of view, from the framework point of view, three things determine commodity prices, and three things only. Number one, the US dollar. You had two massive super cycle bull market in commodities. One is in the 70s. That's the one the dollar broke down after the Bretton Woods system collapsed. The second super cycle in commodity was 2000, the decades from 2000 all the way to 2008, when the dollar came down for almost 10 years. So all I'm saying here is the first thing first you have to have is a sustained decline in the dollar. That's a 1/3 of the factor. The second factor that you need to have is a sustained increase in demand. The third factor has to be disinvestment in supply side in response to very low prices for a long period of time. You see, 70s, we had a huge surge in commodity demand from Asia. Japan industrialized very fast. Korea basically took off. All those Asian countries took off in the 70s. And now you had a collapse in the dollar. And of course, disinvestment problem in the 60s, and supply side problem because of the Middle East geopolitical tension. You got two oil crisis, embargoes, and things like that. So this thing is perfect for a super cycle commodity. Last decade it was China. The Chinese demand just took off, and then you had a dollar coming down for about 8 years, and then the supply constraint. You guys probably know better. The 90s commodity prices just did not go anywhere. Everybody basically give up on commodities, and then all of a sudden you have a demand surge. Prices went through the roof. Going forward, I have a hard time to believe that we will have the same kind of a environment as the 70s and 2000s. I'm not smart enough to tell you a long-term, it could be a 10-year story, but I think I'm confident enough to tell you probably the commodity prices are going to run for a year or two.
Okay. And you have said, I mean, over this conversation,
Yeah.
as you just said, we're going to have high commodity prices, depreciation of the dollar, the economy is
Right.
recovering,
Yeah.
global economy is
Yeah.
recovering. You said over the conversation, okay, Chile is something interesting, Latam is something interesting, and we should be happy because of what is happening worldwide in order to be affected positively to the region.
Provided the
But
Brazil can get their act together.
exactly, I was going to take you to the region, to Latin
Yeah.
America. So overall, you see that is a nice environment to be positioned in
Yeah.
Latam asset, right?
Yeah.
But
I
but sometimes, and just to finish, I mean, sometimes we start with a good view in the region, but something happened inside that at the end is not
I know.
reflecting returns, right?
I know. So for that, you have to tell me when to get out.
No,
I know the
no,
macro picture is beautiful. I look at Brazil. I look at Chile. What could be better? You got a copper prices that is at $4. you got a big chunk of the world eventually is going to ban fossil fuels. I mean, California is 2035. Sorry, 2035. No combustion engine car can be driven on the streets of California. Europe, 2035, 2032, they're going to ban the combustion engine. They have to convert all these cars into electric vehicle. And each electrical vehicle consume, don't quote me, but I think 50 kilos more of copper than combustion engine. This is a secular story for copper. So, of course, if you have another social chaos unrest, I can't tell you. I mean, too bad, you missed an opportunity. So that's why you guys need to tell me whether the political situation is going to be stable enough for people to capitalize on that. I do think that from the economic point of view, no brainer for Brazil, for Chile. For Brazil, of course, you got this president is a bit of like a Donald Trump. Basically you got all this monetization of hands out. Whether they be able to stabilize the currency, that's another issue. But I think in terms of broad environment, in terms of macro background, it cannot be too bearish. I mean, look, the soybean shipment from Brazil has been going through the roof. You guys know that? I mean, it's just gone through the roof. The number is mind-boggling because of agriculture. Prices are booming too. We had 2018 underplantation of lots of agriculture products, and the prices actually 2018, 2019 was low, and then you got a pandemic also really did hurt the plantation. Now the prices start to take off. The prices sometimes gone vertical. That's why I'm thinking, look, sometimes things are not that obvious, but I think sometimes it is obvious. So that's why I think I'm more favorable on the commodity plays in LATAM, and for that matter, maybe South Africa too, than Asia, because Asia, yeah, they got everything in order, but look, they got the multiples that are too high.
And I mean, the environment might be suitable to invest in Latin American assets, right? But usually we have some like local topics that, I mean, make it harder to market to provide those returns.
Yeah.
And as you said before, we have a constitutional process in Chile. In Mexico, we're going to have some elections in June. We still have some like political tensions in Peru regarding what is going to happen with elections. Brazil, they need to make some reforms, right? And they have election next year. Will those political events damage their returns? Is there something that makes you be concerned about the process that is going to take place in those countries? Is there one that might affect the returns of the market, or is something that the markets at the end is going to leave behind and keep running?
I think depends on the degree of the political and social problems. Most of the time, I remember very clearly when in 2000, when I forgot about the name of the president just got in, but everybody saying that he's a left-wing president. You got to be proud. I think it was Lula in 2000, and everyone saying that who's the Lula's predecessor. But anyway, the story was at the time, the consensus is that the government is going to turn left. It's going to be very socialized economic program. Everybody was scared to death, and then it turned out that actually the market was wrong, and then the whole commodity boom lift off the Brazilian stocks. I think it's all about degree, and also there was the same concern about Mexico. And look, Mexican markets has done reasonably well. So I think it's all about the degrees. Sometimes the politician campaign on one side and then run by, on the other side. But I do think that you got to be careful on the big ones, like Brazil. what happened? What happened there? Is there going to be a social chaos? What is the implication of Lula's the ruling on Lula's non-guilty ruling? What does that mean, that he's going to run? There's a lot of uncertainty for your region. For your region, political uncertainty, social risk is always a concern. But I do think that it's depending on the degree. If you had the same kind of a social unrest like what you went through, I think it's 2019. All bets are off. You basically have to change. You have to radically recalibrate your social economic policy. That would be problematic. But if just the election, campaign, the rhetoric, I don't think that's a big deal.
Okay, thank you very much. Chen, we have some questions from the audience.
Sure,
some of them, I know that you have covered them, but some of them, like, I think it's valuable to mention them again in order to, to all the audience to know your perspective regarding what the Fed is going to do.
Sure.
We are asked if the Fed is going to implement a kind of curve control, or if they are going to be kind of operation twist type, and if there is a threshold that can trigger the Fed to take another kind of measure to stop the increases in the yield.
This is a good question. I gave you another perspective just for you to think through. Mm-hmm. Historically speaking, if you look at a recent history, I don't think it's a recent history, just look at the post-war history. The long end of the curve, the backup in the long end of the curve alone has not been able to generate a huge economic calamities, meaning long end of the curve alone is not going to inflict a lot of economic damage on the economy and stock market. Why? Very simple. If long end of the curve is too high, the borrowers can simply slide down the maturity curve. They borrow short. That's why when you have a steepening curve, most of the time, the steepening curve is associated with good stock market, rising commodity prices, and the likes. So the problem always comes when the short end of the curve also start to go up. The entire curve start to move upwards. That's when the problem starts, because borrowers got nowhere to go. You have to pay more, no matter long and short, and you basically have to pay more. That's why if you look at this chart here on your right-hand side, this is the 2-year Treasury yield curve, 12 months rate of change. This is speed, the speed of bond yield increases in the short end of the curve. You can see that in recent history, almost always, when the short end of the curve started back up, that's when the stock market started to run into problems. Okay. So all I'm trying to tell you is the Fed is definitely not concerned about the bond yield. For sure. If they're concerned, they're going to say it today. They're happy. The long end of the curve is steepening up. It is reflective of better economic growth, a possible boom in the US economy going forward. So all I'm saying here is they have no need to manipulate the curve. But if the entire curve start to move up, that's when you got to be careful.
Okay. But there is something like really interesting what is going on regarding other central banks, such as the European Central Bank on the Australian one, right? Because they don't feel that confident as for example, the Federal Reserve about what is going on in the yield market. We saw some messages that they are going to be a little bit more aggressive the second quarter, the European Central Bank, but they are not going to increase the program, right? Do you see that there might be a kind of mismatch regarding what the Fed and the other central banks are doing, or they are just they will need to follow him? The European Central Bank, the Japanese central bank, the Australian, the Latin American one will have to follow the Fed, or they will need to resist a little bit, considering that the economy is not, the global economy is not recovering like a line.
With the US, you mean the economic growth is out of sync between
Exactly.
the US with the rest of the world. I think that's why I think, you got to be careful on the weak dollar thesis beginning of, well, maybe second half, maybe beginning of next year, because the Fed, as I said, the disparity of economic growth where the US is charging ahead, where everybody else is still more or less behind. That actually, by definition, means that dollar probably going to start to turn around once the Fed start to get caught up. Until then, I think it's fine. I don't think the Fed, I don't think the other central banks will be able to do anything.
Okay.
Why would they do that? Why would they do anything? The Europeans, the Japanese, if you look at Japan's inflation is back down to deflation. And if you look at the Europeans, their growth, some countries are still pretty soggy. So I don't think they'd be able to do anything. And that actually in itself also probably will limit how high bond yields will be, because the European bond yields have a strong influence on term premium of the US.
Okay, and moving apart a little bit from the financial market, going a little bit to the ESG trend that we have seen over the last years, environmental, social, and governance.
Yes.
This trend is moving and affecting, not affecting, but being included in every portfolio that the practitioners include in there and offers to their clients.
Yeah.
And it seems that it's moving to be the norm, right?
Yeah.
So when it becomes the norm, how is it going to affect the market? What do you think that is going to happen with the market? Might we see a different kind of equilibrium? We should, because some people is saying that they are going to offer, because you're assuming less risk, they're going to offer lower returns. Some people said the opposite. I mean, should be more beneficial for the financial markets. What is your perspective?
I think this whole thing is still playing out. You cannot say with any certainty, but I do believe one thing though. If you look at the price profile between crude oil and copper, they are totally different. I think this SEG, I think this socially responsible thing, I think the impact will be that I think the fossil fuel industry, from a secular perspective, is going to be very hard for them for the prices to make new highs. That's why I think, I'm bullish on oil. Don't get me wrong, because we simply don't have enough oil. When you have a boom, oil prices are going to go up. But if you put a gun in my head saying, we're going to see a new high in oil prices, no way. Again, as I said, big chunk of the world is going to ban combustion engines. Same thing, renewable. You can see the renewables are already going through the roof. These are socially, environmentally friendly sector. If you look at a green technology, I think the PE ratio is already happening. So I don't know how that is going to impact returns. My sense is that for the companies that are within that rim, the valuations are going to be a whole lot higher than the companies that are outside that rim.
Okay, and also you said something really interesting regarding copper, right? It seems to be a new secular trend. Which other mega trends do you see in the market that could be could be exploded by the practitioners to be included in their portfolios?
Well, copper is gone vertical. I think it's going to be a pullback at some point, but I think the profile is very bullish. There's no question about it. Another thing, I don't know how durable that will be, is the commodity, is the agriculture commodities. As I said, the agriculture commodity has been white noise for a long time. All of a sudden, right now, we had a shortage that has been developing. I think that's probably going to be ripping for a while. Big long-term secular trend. To be honest, Very, very difficult for me to project. You know, I can get.
Sorry, Chen. I would ask to the audience to shut down the microphones in order to have a fluent conversation with Chen and maximize the time to enjoy his answers. So thank you very much.
So I don't know. I have to be quite honest. I cannot see. I do think that this commodity complex as a whole has 1 or 2 good years, and beyond that, let's reassess. You know, you never. To be honest, nobody has been able to foresee a secular move until you are into it. So if you have, you know, 2 years, or let's say the commodity runs for 2 years, and then, you know, we have a look, and then still see a lot of juice left, and then we're making a reassessment. By the, you know, don't be looking at it too far off. Next 2 years be good enough. Be long commodities, be long cyclicals. I think that's good enough. If we'll have a return of some kind of a steady inflation, rising inflation expectation, renormalization of monetary policy, this is the place you want to be.
Okay, and we have another question, Chen, probably one of the last one from the audience regarding the debt excess theme related to China. Which one is your opinion about this topic? I mean, it's something that we should be worried about, or is something that doesn't need to be a current concern, or is something that should be postponed to the future that we might face or should be concerned in the future?
Okay, that's a good question. If you have not bought the Chinese shares, don't. If you have already bought Chinese shares, sell half. Okay? Why? As I said, the Chinese government is renormalizing policy. They are the interest rates are not falling anymore. Look at this chart here. The red dotted line is social financing. Think about that as a total credit. Total credit just went through the roof here. It's ripping. If you want to make a bet on this red dotted line, which way this thing is going to go, I think most people will bet that this thing probably going to roll over instead of just keep shooting higher. Okay, that's why I think the if you haven't bought Chinese stocks, a little bit be careful here. Do I believe that the Chinese policy is going to go another? You can see they've made 3 mistakes over the last decade. The first one was right here. The second one was 2014, 15. And the third one is 18. They try to deleverage the economy. Now they're still concerned about, you know, the leverage build up too fast. What's going to happen is probably they're going to slow down the expansion. Okay. They're going to slow down the monetary expansion. They're going to probably slowly moving rate higher. Why slowly? Not very dramatically. Look at here. The inflation is still very low. You can see the inflation is still down here. I think the property prices is a little bit perky now in some cities, but a nation as a whole, it is under control. It's not a complete out of whack. These are the reasons that led me to believe that the Chinese policy is going to tilt. It's going to tilt towards tighter stance instead of easier stance. That usually be reflected by the stock market. Stock market actually has down about 10 or 15%, depending on which index you're looking at. So that's what I'm saying. This is a modest monetary tightening, but nonetheless, it's a tightening. You get your most gain when policy is easing, when the economy looks really bad. That's always the case. You buy the stock market when the economy looked the most awful time, and when the policies start to really hose the system. That is over. That is behind us. The economy looks very strong. The policy is looking for renormalization. That is usually not a sweet spot for stock market.
Okay, Chen, we have gone through your economic view, markets, currencies, commodities, yield, stock market, rotation sector. Chen, I would like to finish this conversation saying thank to you for sharing your thoughts and economics and market perspective with us and everyone who has been connected to this call, especially to our sponsors, Sartor Finance, Monet Asset Management, FINSA, and Scotiabank, who support us on our activities. Also, I would like to invite to the members to participate and be engaged in our CFA Society. Currently, there are several committees that you can be part of and activities that the society regularly offers, such as the webinar that we had today. Thank you, Tim, for being with us today. Thank you, everyone, for connecting to this webinar. And I hope we can meet each other in our CFA Society activities. Thank you very much, Tim.
Bye-bye.